Hello everyone, welcome to our research presentation and market outlook for the month of March 2022. The presentation contains update on global markets, domestic equity and fixed income markets along with our outlook. On the global market front, in the month of February 2022, escalating geopolitical tensions after Russia attacked Ukraine, which raised concerns about global energy supply disruption, elevated inflation and increase in crude oil prices to multi-year high led to decline in most of the global equity indices. On the US equity market front, US equity market witnessed a volatility led by higher inflation, strong employment conditions and rising geopolitical tensions. Dow Jones Industrial Average Index and S&P 500 Index fell by 3.5% month-on-month and 3.1% month-on-month respectively. On the Chinese economy front, China's GDP grew by 4.0% YoY in Q4 CY21, slower than 4.9% YoY growth seen in Q3 CY21. This was mainly due to weaker performance by construction, real estate and technology sectors and muted consumption demand. Energy crisis and lockdowns and travel restrictions to contain the COVID-19 infection also dented economic growth. Meanwhile, People's Bank of China became accommodative to support the economy. Going forward, equity market could remain volatile due to ongoing issues between Russia and Ukraine, high inflation data points and policy action by US Fed, which would be important for US as well as global equity markets. On the liquidity front, central banks of some emerging economies like Brazil, Russia and UK from developed market have increased interest rates following revival in economic growth and higher inflation. US Fed Chair Jerome Powell indicated that US Fed is likely to raise interest rates in its upcoming monetary policy, which is scheduled in the month of March 2022, citing inflation well above 2% and strong labour market. Meanwhile, Bank of England raised its key interest rates by 25 basis points to 0.5% in its policy meet and signaled modest tightening in the months ahead after raising interest rates by 15 basis points in its previous monetary policy meet. Whereas European Central Bank left its key interest rates and forward guidance unchanged. ECB said that it would discontinue net asset purchases under Pandemic Emergency Purchase Program, that is PEPP, of a private and public sector securities at the end of March 2022 to deal with higher inflation expectations. Going forward, central banks would closely tracking inflation data points and economic recovery of their respective economy, which would be important for further policy action. Apart from hike in policy rates by large global central banks, market would be tracking the pace of balance sheet reduction. Which is likely to have direct impact on global liquidity. On the domestic economy front, India's GDP and GVA expanded for the fifth consecutive quarter after witnessing a contraction in H1 of FY21 as it grew by 5.4% YoY and 4.7% YoY respectively in Q3 of FY22, which was lower than market expectations. Meanwhile, high-frequency indicators like manufacturing PMI, GST collection, forex reserves, 8 core sector growth, etc., amongst others, have witnessed improvement, whereas some data points like slowing GDP growth, rising trade deficit, rising crude oil prices are leading to a rise in concerns. Recent sharp up move in crude oil prices is a key cause of concern as rise in crude oil price by each USD increases India's import bill by close to USD 1.43 billion, which is leading to higher current account deficit. While passenger vehicle sales, retail loan growth and bank credit continued to show improvement, some of the other key data points like consumer confidence in the month of Jan 2022 indicated a moderate impact of Omicron on the urban demand. Urban demand stabilized as impact of Omicron variant of COVID-19 starts to ease. However, FMCG companies have seen rural demand for their products slowing as these companies had to increase the price of their products due to higher inflation. Rural demand, which seems to be weak, but expectations of a better monsoon, a gradual migration back to urban centers and stronger government support to help demand recovery in rural area. On the domestic equity market front, Indian equity market ended a highly volatile month on a negative note, driven by geopolitical issues between Russia and Ukraine and sharp selling by FPIs in equity markets. Domestic equity indices, S&P, BSE, Sensex and Nifty 50 indices were down by around 3% for the month of February 2022. However, buying at a lower level by domestic institutional investors cushioned the losses in domestic equity indices in the month of Feb 2022. On the valuation front, while equity markets have corrected recently due to concerns over geopolitical issues and fear of global liquidity tightening, valuations have continued to remain rich. S&P BSE Sensex is trading at 23.4 times of FY22 estimated Bloomberg consensus EPS of Rs 2400 and at 21.2 times of FY23 estimated Bloomberg consensus EPS of Rs 2650. Sensex EPS growth estimated were revised downwards for FY22 from Rs 2500 to Rs 2400 and for FY23 from Rs 2800 to Rs 2650. On the corporate earnings front, Indian corporates could continue to show stable top-line performance on the back of improving domestic fundamentals, strong global demand, and increased policy focus by government on reviving capex cycle. Although higher commodity prices could impact the margin performance in the near term, this can lead to further volatility in earnings and stock prices in the near term. Our long-term view on Indian equity market remains positive, and hence any large dips in equity markets could be used as buying opportunities by investors with a 2 to 3 years investment horizon. However, the key risk for the markets are as follows: ongoing geopolitical tensions between Russia and Ukraine, higher crude oil prices, sharp appreciation in US dollar index, acceleration in the pace of unwinding of liquidity, and any negative credit rating action amongst others. On the investment strategy front, we continue to maintain an investment deployment strategy of 50% lump sum and rest 50% to be staggered over the next 3 to 4 months. Investors could focus on large cap, multi cap, flexi cap, value, hybrid equity and infrastructure funds for investment with a horizon of 2 to 3 years in line with their risk profile and product suitability. That is all on the global and the domestic equity market. Now we shall move to the fixed income segment.
Hi everyone. On fixed income markets during the month of Feb, domestic G-Secs remained volatile and closed on a negative note. Yield on the new 10-year benchmark G-Sec closed higher at 6.77% on 28th Feb as against 6.68% on 31st January after rising to a level of 6.89% during the month. G-Sec started the month on a negative note, tracking the union budget for FY23, wherein bond markets reacted negatively on account of the announcement on the higher than expected estimates on fiscal deficit as well as government's market borrowings. G-Sec yields declined, however, thereafter from the highs tracking RBI's monetary policy. G-Sec yields declined thereafter from the highs tracking RBI's monetary policy meeting outcome and cancellation of 2 weekly G-Sec auctions during the month. The RBI delivered a surprisingly dovish monetary policy in Feb, which could have pushed the policy normalization a little further. In the monetary policy, the RBI kept policy repo rate and reverse repo rate unchanged at 4% and 3.35% respectively, and also decided to continue with the accommodative stance as long as necessary. The focus of the monetary policy continued to be on supporting the nascent economic growth recovery. The RBI governor also sounded sanguine on the inflation trajectory. However, with sharp rise in commodity prices, especially crude oil prices, the RBI may have to revisit its inflation forecast and its sanguine view on the same. Retail inflation based on consumer price index rose for the 4th month in a row in January to a level of 6.01% year-on-year as against 5.66% year-on-year in the month of December 2021. Brent crude oil prices rose sharply and closed the month of Feb at USD 101 per barrel and continued to rise further to multi-year highs in the month of March. With no sign of de-escalation in geopolitical tensions, commodity prices could continue to remain high in the near to medium term, which may spell trouble for not only Indian inflation but also other macro variables. With large G-Sec supply and limited scope for the RBI to provide demand support, yields are likely to trade with an upward bias. The supply of government securities is fairly large and will require major support in terms of additional demand other than the current natural market demand. With high surplus liquidity, it is uncertain as to how the RBI would provide demand support for government's market borrowing, which will continue to be a key variable for the trajectory of bond yields. Liquidity withdrawal by the RBI is likely to be gradual as the RBI's current focus is supporting economic growth. The yield curve has continued to remain very steep with opportunities available across various segments. The up to 8-year segment on the yield curve provides opportunities of attractive term spreads across tenors. The steepness in the yield curve is expected to continue in the near to medium term until some clarity emerges on GSEC supply absorption support by the policymakers, as well as the impact of the geopolitical tensions on domestic macros. In terms of fixed income investment strategy, in light of expected volatility, currently investors with an investment horizon of 12 months and above can look at short duration funds and corporate bond funds. Investors who would like to lock in current available yields and are not comfortable with volatility can look at relatively longer tenor fixed maturity plans. Investors who have relatively longer investment horizon could look at target maturity index funds that invest in papers like PSU bonds and state development loans, with funds having maturity in the years 2025, 2026 and 2027. For a horizon of 3 months and above, ultra short duration funds or low duration funds can be considered, whereas for a horizon of up to 3 months, investors can continue to look at overnight funds and liquid funds. Investors should continue to invest in line with their risk profile and product suitability. That is all on the research presentation for March 2022. Thank you everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.